All right, let's bring you closer to that one. We're now joined in our Johannesburg studio by our resident geo-economic analyst, Mr. William Gumede. It's always a pleasure to see you, sir. Thank you very much for coming through. Now, in spite of the high growth that we see in Africa, why is it that African countries are continuing to get such negative ratings? And really, what are these ratings based on?
I mean, it's an extraordinary trend. We see in the last couple of years is that African countries are rated at a much more negative level than the equivalents abroad. I mean, even though they're growing, I mean, some economies, say for example Cape Verde and so on, economies which are African economies which is actually quite well balanced economies. They are rated by the credit rating agencies at a much more negative level than, say, for example, in Portugal and Greece when they were in crisis, in economic crisis. Now, the first thing is just in a sense is a lot of these ratings are really based on perceptions. And often it appears, that the global credit ratings, they look at African countries, and even though African countries are growing at really high levels, they argue essentially that these African countries may not be able, to pay back, loans and so on. So they really, so most of the rating agencies are actually saying that, African countries are at greater risk of defaulting on loans and so on.
Now, I mean, you mentioned the fact that these ratings are based mostly on perception, but then why are the ratings so important then for a country's image if they would be based on perception?
Many African countries are now going out and actually borrow or they issue bonds, euro bonds and so on. Now, if you want to do that, if you want to play in that market as an African country, you need to be rated, that's sort of what the rules say, and so on. And if you rate it negatively, then when you borrow from outside or if you issue bonds, then you pay back, at higher interest rates. So that is quite crucial. That's why it is important. Now, unfortunately for many African countries is, although they're growing at very high levels, African countries often grow on the back of export of one commodity. Now, if you just have oil, one commodity, or metal, if there's any changes in the global prices, for example, in that metal or in oil or in the production factors, that your economy is really at risk. So because most African countries are really, let's call it one commodity economies, they're systemically vulnerable. So, when rating agents rate them, they will say, look, because this economy is not very diversified, it's only based on really one commodity, it's a bit risky.
And pardon me for dwelling on the issue of perception and the fact that these ratings would be based on perception. Then in that case, how accurate are these scales in really depicting a country's economic status?
No, you know what, it's not very nuanced. And, often, with the credit ratings, you can't really compare properly which African country is really at risk and which, African country is actually, in a much better position. We know broadly, like, Botswana as an economy has the best rating on the continent. Botswana's rating is really the equivalent of Japan's rating. Now, we understand it has, the fundamentals in Botswana really is good. It's a robust economy. It has foreign reserves of more than $7 billion US. So that's, that's really we can understand. But there's other economies which, like let's say Cape Verde, which is broadly quite a balanced economy, and and one wonders why it would have such a negative rating. Now, of course, there is also real factors that African countries will have to do. The first thing is many African countries are actually they're now borrowing more. There are less development aid coming to African countries. That is what's changed the last couple of years because of the global crisis, the Eurozone crisis. So African countries are now actually looking outside, to issue bonds and to borrow money from outside to finance infrastructure spending. And of course, it's good to have infrastructure spending, but, to borrow money from outside and so on. So despite the fact that African countries are growing at a very high pace, they still need extra money from outside, to spend on infrastructure investment. Now, that nexus, of needing money from outside is where the problem is, because what's also happened in many African economies, every year, despite them growing, they actually spend more money than the income that they have. So then they have to supplement it.
Now, what can African countries really do to, or differently rather, in order to change the negative ratings, rather get positive ratings? I mean, we're talking about the fact that African countries need to get their own companies that do the ratings. I mean, we can name the companies that we know to be popular to be doing these ratings. What can African countries really do?
You know, the first thing is that African countries must manage the economies better. You know, that's the first thing that they really need to do. And then secondly, what they need to do, they need to diversify the economies. You know, so if you're oil-based economy, move into other sectors as quickly as possible. But also maybe thirdly is African countries can actually club together, or even private individuals, entrepreneurs in Africa, can actually set up our own rating agencies, you know, which will be adding much more nuance and may give us a better perspective. But it's also fourthly, I think African countries must trade with each other more, and even barter with each other more, and so on. And also we must also borrow from each other more rather than looking for money outside the continent.
All right, always a pleasure speaking to you. Thank you very much, very informative. That's our resident analyst, William Gumede, speaking to us about sovereign ratings.